we've actually, I think, got the largest number of slides we've ever had for one of these presentations. So we're going to try and go through at a reasonable pace so we don't spend the entirety of the morning chatting to you guys. The first component of what we're going to talk about is just going to be a little update on performance. We've tried to spend a little bit of time looking at not just how we've done over the course of the last month, but also how we're doing over the course of the last year, and also versus some of our peer group as well. With the absolute return focus that we have, we've seen sort of very strong performance kicking through in both the dollars and the euros, whereas the sterling was hit mostly by some of the currency moves and some of the swings and gilts. When we're looking at the absolute return, our target return looks actually quite low when we're looking at this spread over inflation, and trying to hit for dollars 27 or 35 basis points on a monthly basis feels like quite a small number. But when you're trying to do it month on month, irrespective of market movements, it can get quite challenging when we're seeing a little bit of volatility feeding through in the markets. Now, obviously, when you're looking at a 1 month performance number, it doesn't tell you very much, especially when we're looking from the perspective of the end of November. So what I've done is try to break some of this down into how we're doing versus the peer group. So what we're focused on for a lot of our clients is the conservative and balanced models. So I've split them out versus the ARC private client indices, which is submissions of thousands and thousands of private client portfolios across the industry. The nice thing from our perspective is dollars, euros, and sterling conservative and balanced, we've outperformed our peer group by a fairly wide margin on a year-to-date basis. I mean, the sterling conservative is almost an embarrassment of outperformance, and a lot of that has come from some of the fixed income moves. But what we're looking for is actually performance that isn't necessarily quite that high, as strange as that seems, because we don't want clients, especially when they're looking at 11 or 12% on a conservative portfolio, thinking that we're going to be generating that year on year going forward. Our actual target return for conservative is CPI plus 1 to 2%. So our sort of net of fees target is about 4% on an annual basis. So to be up 10, 11, 12%, or in the case of the sterling, nearly 13%, is quite significant. But this is how we're looking at fixed income and equities, two completely separate buckets, both kicking through quite a substantial amount of performance on a year-to-date basis. But then we thought that we'd try and drop one step deeper when we're looking at performance comparison, rather than just looking at the sort of overall aggregate ARC returns. So I just grabbed the dollar conservative as a sort of most frequent model that we're using when we're speaking to clients. On a year-to-date basis, up 10.8. This is up to the end of September, because ARC do theirs on a bit of a lag. The 25th percentile, so the top 25% of accounts were up 8%. So we still managed to do fairly reasonable performance versus those on a year-to-date basis. Even putting it through to a 1 year rolling, we're 9.6% versus ARC at 4.7%. So it's quite a substantial outperformance. The thing that we're very focused on is trying to do that with minimal volatility. So our annualized volatility for this is just around about 5% as well. So to be sitting at just under 10% performance with 5% volatility on a 12-month basis is something that we're pretty happy with as an investment team. To go one step deeper, rather than just looking at year-to-date, I thought I'd put up monthly performance numbers. When we start looking here, and you can start doing some of the comparisons month to month between the portfolio and the ARC portfolios. So we're kind of looking at our performance numbers versus tens of thousands of client portfolios. The one that annoys me the most is August for us, when we were negative. Being absolute return investors, we're trying to generate this consistent positive return for our clients, irrespective of market movements. Bizarrely, when we're negative, we saw that ARC was actually positive. And this was because we were very cautiously positioned from an equity perspective versus a lot of the industry. Whereas in May, we had the contrary result, when the industry was down 60 basis points and we were up just over 100 basis points, to just over 1%. And we did that through changing our equity exposure. Removing the lower limits that we can hold of equities means that we have a lot more flexibility. It provides us a little bit more rope, and so far this year we've been nimble enough to be able to go in and out of the equity markets And we currently sit on this model portfolio with around about 1.5 to 2% in equities, versus a lot of our peer group that are sitting in the sort of 15% range to 20% as a lower limit on their conservative portfolios. This means that the return dynamic is very different. The volatility profile that we're seeing in the portfolios is very different. We think this is much more aligned with how private clients want their portfolios to be invested. And we're sort of sitting with this mentality of, if we want to buy equities, we'll buy equities. If we don't, we won't. We're not going to own them just because they're in the benchmark and we feel like we should be following the benchmark. So our focus is at the moment on buying within the thematic component, really good quality single stocks, and within the core component of equities, we're looking at, do we want to take this global equity exposure and how do we think the market is performing? I'm going to come back to that shortly, but Jeff's just going to talk you through the fixed income component first.
Thanks, Simon. Good morning, everyone, and thanks for attending. This is our usual fixed income traffic light system chart that we use to illustrate our strategic asset positioning. You can see that there's fewer and fewer green spots, which are the areas that we like. That's a combination driven by our refined process through our scorecard methodology, and also there just being few opportunities in the market space. Now, places that we still like, we like 10 and 30-year US government bonds. Now that the Fed is on a period of pause through the election year, and the next Fed event meeting that's coming up in November, we think will largely be a non-event. We're happy to earn some carry in the region of, say, 1.8% for a 10-year bond. So that's 15 basis points of carry each month. Elsewhere in Europe, we're largely underweight across the curve, and we have a neutral positioning in investment grade bonds, largely driven by the negative yielding environment. In the UK, again, with Brexit uncertainty coming up and with an unlikely move in rates from the Bank of England, we're standing on the sidelines at the moment and maintaining a neutral position and keeping our powder dry. Elsewhere, we think that European high yield paper is one of the few attractive opportunities that there are in the fixed income space, and I'll elaborate on that further in the next slide. Oh, actually, so as we've spoken about a lot over the past few months, there's actually very little opportunity to earn a positive yield in the European markets at the moment. You can see this whole red area here, that represents a part of the fixed income universe that's negative yielding. There's now $17 trillion worth of debt on a global basis across sovereign and corporate bonds that's negative yielding. And in this area, spots that we are positioning, we like Italian and Greek 10-year paper, which still only yields at provides yields of above 1%. We got into this at above 2%, so that's turned out to be a very good investment from us. But elsewhere, you can see that there are very few opportunities. But through our MVST process that we've been working on, there are some spots, and I'll highlight those further on. Okay, so onto our government scorecard for US government bonds that we introduced 2 months ago. By and large, there's been no change to our recommendation. You can see that we had a confidence factor of around 6% to sell, and now it's flipped over because in our 17 indicators in total, one of them has switched, but it by and large represents our neutral positioning. Again, it's based on commentary from Jay Powell, who says that he's going to evaluate macro data points for the next 3 to 6 months, and it's unlikely that there'll be any movement from the Fed front on policy decision making. So we're happy to earn the carry for now until there's further change. Now, what we are looking out for, though, in the US is consumer sentiment. We've pitched buying conditions for large household durables, and note that it's displayed on the right-hand side, on the right axis, and it's inverted. So it goes from 200 up to 80 because of the inverse relationship against unemployment. And you can see that this relationship between consumer purchases and the unemployment rate is starting to break. That relationship's breaking. You can see a divergence. So that's something we're looking out for, and it could present a buying opportunity for government bonds. As you expect, we've seen that manufacturing activity has declined. The latest ISM print for manufacturing was again below 50. It came in at 48 in October. But we're still seeing that the US consumer is still holding up. It's still strong in that area. But we could expect that if the US consumer was to show, if we were to see weaker data points from on the US consumer front, how it could trickle down to reduce spending and consolidation of stores, and essentially trickle down to job losses and then a slowdown in the economy. But for now, we're just watching out for this point and timing it so we can see that we can find an opportunity to actually get involved with US government bonds. Now, previously we had employed a barbell strategy where we were long T-bills and long the 10-year part of the curve and then short the belly of the curve. But that opportunity doesn't exist anymore. You can see that front-end bonds have rallied significantly. This was after open market operations from the Fed. So 2 to 3 month T-bills only yield 1.6% as opposed to 1.8% just a month ago. So now we're actually recommending to our clients that they position themselves at the longer end of the curve, either at the 10 or 30 year, where they can gain a pickup of 1.8% or a pickup of 40 basis points to that. So that's 2.2% all in yield at the 30 end of the curve. We have a duration positioning around 3.5 years, which is roughly 50% of all US government bonds. And we've now rolled out the scorecard methodology onto our European government bonds. Without even looking at this, you can probably tell by what I've said earlier that we have an overall negative view on the European government asset class. And you can see it by this wave of sell recommendations across valuations. So that's sell based on the valuation of European government bonds relative to equity dividends, relative to other regions. That overall, we have 11 sell indicators and an overall recommendation to sell with a fairly strong confidence factor, I would say, of 29%, which is increased from the previous month. And focusing on valuations, despite on a 90-day basis, some value propping up across the universe, it's still negative yielding in large parts of this universe. And we've espoused and stated to our clients a number of times that we are not interested in paying governments or corporates in order to hold their bonds. Italy and Greece, as I say, is one of the few areas that we're still interested in. And instead, we've been enhancing the yield of our portfolios by investing in quasi-government entities, such as the Deutsche Bahn finance bonds. They've got 2033 bonds that yield roughly 0.5%. And we're happy with this bond because it's AAA rated, it's backed by the local government, and it offers a 70 basis point pickup to the Deutsche Government bond. And we also duration hedge this position by essentially taking a short position in a German government future, which then actually earns us positive carry, which again enhances our overall yield in the portfolio. Now, last month, we preferred US and European investment grade bonds, and we would actually make the recommendation to switch into European high yield this month. And that's partly based on the value that's offered. It's one of the few areas that still looks attractive. but also due to the structural composition of the European High Yield Index, which has much fewer, has a much smaller proportion of energy companies compared to US high yield. And there's also the technical factor with the support from the ECB resuming its asset purchase program. We think these will be supportive for this area, and it's one of the few areas, as I say, that actually looks cheap on a 90-day basis. Now turning to the US markets, you saw last month that the AAA longer end of the curve was the most attractive area for us, and a few other spots in the BBB space as well. But with monetary easing, with the loosening of monetary policies, there's actually very little value left on the table this month. So as you can see, on a 30-day basis, everything looks expensive. So there's little value there, but what we're gonna do in order to generate alpha now is to select individual names in sectors where we think there are still opportunities to earn a decent yield. Now, previously we've been looking at ratings versus maturities, but now we have the resources and we're expanding our coverage to include sectors. So again, this is the US investment grade universe, and it largely looks expensive. If you look at it, it's mostly red, indicating that on a 90-day basis, it's trading expensive. There are some exceptions. That includes the healthcare and real estate sectors. Healthcare we view as defensive, and it's largely insulated from any uncertainty or negotiations that pertain to the US and China trade war. So we actually like that sector. And real estate, with the low rate environment, which is supportive for mortgages, that's another sector that we also like. But there are two other sectors, energy and transportation, that are also cheap, but we think these are actually cheap for a good reason, as transportation has largely been negatively impacted by lower trading volume, and also the energy sector has been negatively impacted by uncertainty around the geopolitical tensions between the US and China and other various regions as well. And then finally, turning to our credit scorecard, there's actually been very little change compared to the previous month. We had a low conviction buy, and this was driven by decent earnings growth and also balance sheet strength, which continues with third quarter earnings coming out. We've seen it's mostly been a surprise to the upside, and revenue growth has been roughly in that low single digit region, which we're still comfortable with. Ratings have surprisingly been to the upside this past month, and on a year-to-date basis, we've seen more upgrades than downgrades. And a year ago, we were talking about anxiety over BBB rated companies and the potential for a lot of fallen angels dipping into the high yield index. But with 3 rate cuts now from the Fed, there's been a lot less fear in the market in relation to this segment. And we've looked at names such as GE, which has been able to continue to reduce leverage through either asset sales or also improving their operations and improving their underlying free cash flow generation. So we think that the BBB space is, again, an opportunity on a fundamental basis. Otherwise, we think that we're going to maintain a low conviction buy on the credit side, and we're going to keep our powder dry in order to come in if any opportunities arise. And we do expect choppy waters ahead, so we do think that these opportunities will come up for us to actually find a more attractive entry point than currently. With that, I'll hand that over to Max.
Thanks, Jeff. One of the difficulties that the fixed income team have is having to construct completely separate portfolios depending on the base currency. Equities is obviously much easier because all we have to do is scout around the entire world and find the best investments that we possibly can for our clients. The MVST structure we've rolled out on the core equity, and as Jeff was talking through, on the core fixed income, and now we're rolling that out properly into the investment grade or corporate fixed income component as well. The one that doesn't quite apply to in the same way is the thematics concept, which is what we're going to be focused on in the third part, with primarily Max talking through one of our core and key thematic concepts. But on the equity component, when we're again looking at the world through this perspective of macro valuation, sentiment, and technical indicators, in the same way that Jeff was saying there's not much green on the fixed income side, there's not a huge amount of green on the equity side. This is reflective of our core equity exposure. What we've actually ended up doing, as I said, is basically having no equity exposure on the core component of the portfolios across all of the models. This is harking back to, rather than being overweight, underweight versus a benchmark that holds equities, running from this absolute return perspective of we'll only buy them if we want to buy them. If none of the overall indicators are green, which obviously none of them are, we're not going to buy equities. When we're buying equities, we're wanting them when we have the risk return reward, or risk and reward is sitting in our favor, rather than just importing volatility into client portfolios. So when we are going through each one of these components separately, and we start looking at earnings, which kind of feeds through directly into valuations, even though we've had nearly 3/4 of the S&P 500 report their Q3 earnings, the surprise is 76% beat expectations. But actually on the right-hand side, when you start looking at growth on a year-on-year basis, earnings growth was negative. That's not really a good sign when we're looking at how are these valuations going to improve? How's the market going to become more attractive for us to invest into? We've seen this when we're looking at US top left, UK bottom left, Europe top right, and emerging markets bottom right. Every one of those lines, if you look at the purple line second from the right-hand side, every one of those earnings expectations have been declining. This is a pretty global state of play right now, especially in Europe when it's been quite dramatic. But even another concern on top of that is when you start looking at some of the red lines or 2020 earnings expectations, and we've seen earnings expectations declining already moving into next year. So from our perspective, if earnings expectations are declining, the only way that the equity markets can rally higher is if valuations become more stretched. And we're looking at how stretched are valuations right now and how much more stretched can they become before investors start to get wary and start reducing some of their exposure. And this is the same concept here when we're looking at longer term earnings expectations have been declining. Profit margins are fairly static, but we've still seen the equity market moving high, and a lot of that has come from expansion of some PE ratios. So stocks are getting more expensive on a valuations basis. So when we are looking at our macro valuation sentiment technicals from a valuation perspective, it becomes less attractive and less appealing to own. The macro component straddles both equities and fixed income. And when we are looking at the state of the world, what's happening in the world, how are consumers spending, are they going to continue spending? This one also flows across into thematics and is quite a key component of it. But when we're looking at the valuation on the core equity, there's little that we find particularly attractive right now. Sentiment's an interesting one because we're doing looking at it from a contrarian perspective. So the idea is that when everybody is selling and running away, stocks trade down, valuation becomes more attractive, and that increases our interest in owning stocks. So we're trying to pick up interesting stocks and positions at more attractive prices when everyone else is in the process of running away in a little bit of a panic. However, what we're seeing is the reverse, in that investors are slowly becoming more bullish, increasing their positions, which is what's helped the markets to move a little bit higher, but they have been fairly stagnant for 6 months now. We've been looking at the S&P 500 in this 2,900 to 3,000 range. It broke out slightly on the above 3,000, but it struggled to sustain that and move any higher. Just before we hit on to Max, who's going to talk you through one of our big focuses, which is the emerging market consumer, there's just a couple of things that I wanted to say to try and put this into context. This image is one that we've shown before, and the concept of this is a look at the world. There's the white circle drawn, and there's more people living within that circle than live on the entire rest of the planet. So this is a key component and a key focus of ours. We want to be investing where we're seeing consumption increasing, consumption power increasing, but the power of people. So when we're looking at emerging market consumers, a lot of it is focused within that circle. And then we're trying to look at how has that been developing and where are we going to go from here. So skipping back to the concept of thematics, we are looking from this sort of base of staples, what do we need as humans, irrespective of whether we live in the Americas, Africa, Europe, or Asia. We all have the same requirements of food, water, and shelter. But now that we're in this more technologically advanced age, how are we going to go from here? How are we going to move forward? And where's a lot of this growth and where's a lot of this spending going to come from? So we were looking at Asia from a population perspective, but also from a spending perspective. So one of the almost startling things, in 2000, the amount of US consumption was 13 times that of China. So less than 20 years ago. Today, when we start to look at that differential, it's about 3 times. So there's been a huge growth in Chinese consumption. When we're sort of putting that into numbers and when we're starting to forecast that forward, the Chinese consumer today is about $4 trillion of spending. By 2027, that's expected to grow to 10 trillion. In comparison, the US is at roughly 12, and that's expected to grow to 14, 15. So where we're going to see this huge growth in expenditure is coming primarily from China. Then we're looking at this from the perspective of, well, what are they going to be spending it on? If more people in China are spending more money, how are they spending it and where are they spending it? 2027 is the key year because depending on your forecasts, it's either 2026, 2027, or 2028 when China becomes the same size from an economy perspective as the US. So this is when we're looking at, even if the consumption is not as large as the US, the economy is, and the consumption is growing much, much faster. So we want to get some exposure to that. One of the other numbers that kicks through in 2027 is 22% of Chinese people are going to be over the age of 60. To put that in numbers, that's 324 million people, which is about 5 times the population of the UK. So when we're starting to look at 2027, and thematics is not about the next month, the next year, it's where are we going over the next decade. If we're going to have a lot of elderly people, do we start looking at Chinese healthcare? If we have people with more disposable income, how are they going to be spending that disposable income? What's important for them as consumers? Are they going to be as we were 10, 15, 20 years ago? Or are they going to skip ahead? Are we going to have this Chinese demand for meat continue to grow, which kind of fed through a lot into our food outlook piece that we did? Or are they going to be more environmentally conscious and kind of make more of a faster switch to more sustainable food products, which is something that a lot of the West is currently going through. So a lot of our thematic ideas start overlapping and feeding through into others. And these are the ones where it becomes a really powerful investment idea, because we're not just looking at a stock and saying, let's randomly forecast forward how this company's revenue and profit is going to grow over the next 15 to 20 years. And let's come up with a terminal growth rate. Let's discount those cash flows back. And here we go. It's priced 16.5% below fair value. We should buy that. That's how a lot of single stock selection is done. Our view is, let's look at the sectors. Let's look at where consumption patterns are really going to change. Let's start forecasting forward. What are Chinese consumers going to be spending? what are generally around the world consumers are going to be spending their money on, because that's where we're going to see the biggest growth from an investment perspective. We've seen in the West a bit of a kickback against Facebook, Alphabet, or Google in terms of the sort of harvesting of data. That doesn't really happen in China yet. Who knows whether it will happen, but we're starting to look at, is something like Alibaba, Baidu, is that an interesting way to get exposure to China, or do we get exposure via Europe? Do we look at BMW, LVMH and some of the European, or do we look at even some US listed names? So from our perspective, it's let's look at where is the consumption spending going? Where is it going to get to? How's it going to get there? What are the current interests? How is interest changing? And then at the end of all of that, it's now let's look to see if we can construct a basket of stocks that can outperform. That's the concept of what we've been doing on a year-to-date basis. And our EM consumer basket has outperformed the emerging markets index by just under 15% on a year-to-date basis. Video games, which is one of the other themes that we have expressed in our portfolios at the moment, is also up by a similar margin. And that's not 14% year to date, that's outperformance year to date. And that is versus the video games index. So we're starting to use this combination of fundamental analysis, quantitative screening, thematic ideas to come up with the stocks that we're holding in our client portfolios. As you can see from the initial information that we saw on performance versus our peer group, that's working. We're having performance kicking through on all different aspects of that. On the single stocks, we took out Peugeot and Volkswagen. These were two of our defensive names that we put in, sits under the defensive value. We took them out because they rallied north of 10% within a couple of months of buying them, and they became no longer defensive from a valuation perspective. So we are actively moving and changing our holdings to try and maximize value, but also limit downside for our clients. With that, I'm going to stop talking and pass across to Max.
Thank you, Simon. Good morning, everyone. Thank you for attending. And let me begin with the macroeconomic picture where we compare developed markets to emerging. And if we look at the growth rate for the GDP per capita, emerging markets have been outperforming developed markets. And especially if we look at emerging Asia, this is growing at an even faster pace. And on the right-hand side, what you can see is share of the global GDP based on purchasing power parity, and emerging markets today already are a higher proportion compared to developed markets. And then in terms of emerging Asia, the picture is the same. So it is expected to overtake developed markets by 2023, 2024. And if we look closer at consumer income and compare both consumer income and spending and compare US versus China, so the same picture here is China is outpacing US, and actually over the last, from 2002 and to 2017, it has experienced quite a substantial growth. And the top three categories within that are food, alcohol, tobacco, housing, and transportation. And on the consumer income side, the picture is even better. So China again is outpacing US, and during the same period, consumer income in China increased 5 times, and this is compared to US, which has only expanded by 86%. So when we look at these numbers, we try to break them down and actually try to analyze where this increasing wealth goes to. And one of the first topics is actually tourism. And if we look at the global international tourism expenditures, they have been steadily increasing since year 2000. And then when we compare US versus China, China has overtaken US in 2014. It now stands north of 250 USD billions per year, whereas US is below 200. And one of the subcomponents of the international tourism market is actually growing online travel market. And if we look at the breakdown, the most mature from this perspective is online flight ticketing. This is already stands at almost 90%, but the absolute value is still expected to grow in the future years. Whereas in online accommodation market, it's a fairly immature from the online perspective. And then at the current year, it stands just over 35%. The next sub-theme within the emerging markets consumer is luxury. So what you can see on this slide is the overview of the global luxury market in 2018. And the top three categories within that are personal luxury goods, luxury cars, and luxury hospitality. Altogether, they account for 80% of the total value. And the whole market expanded by approximately 5% last year. Now, if we take a closer look at the global personal luxury goods market, in 2018, it stands at 260 billion euros. By year 2025, is expected to reach at least 320 billion. And then within that component, Chinese consumers are expected to dominate the market. And part of it is also driven by the younger population, so-called Generation Y and Generation Z. And actually, on the next slide, we can see that global luxury consumers market size in terms of renminbi is expected to reach north of 3 trillion. And of that value, Chinese consumers are expected to account for approximately 40% or 1.2 trillion renminbi. And this is compared to the last year to 770 billion. Yeah, and as I said, actually, one of the key driving forces within that is the young generation. What you can see on this chart is post-80s and post-90s generation. They have only started spending the money on luxury goods within the last 3 years. So post-80s generation, they spend approximately 41,000 renminbi per year, whereas post-90s stands at approximately 25,000 renminbi. Yeah, and actually post-90s, they like half of them only started. Actually, 92% started less than 3 years ago. And then as a natural consequence of that is online share within the luxury is expanding. Last year, it stood at around 8% of the whole market, whereas the expectations for the year 2025 that it will expand to 12%. So it's still a fairly low proportion, but this is just due to the nature of the luxury market where people prefer to buy them in physical stores. However, in terms of influence, this young generation follows key celebrities, people with opinions on the luxury market, and this is actually what's been driving it as well. The next subcomponent of the emerging market consumer, as Simon previously said, is healthcare, and this comes as a result of growing and aging population within China. So on the top chart, what you can see, the red bar is people of the age 60 years old and above, and their proportion is expected to grow exponentially. And by the year 2035, they will account for almost 30% of the total population. And then as a result of that is the spending on healthcare is also expected to grow quite substantially across all of the different segments within that. And the whole market is expected to grow at a sorry, 8.4% every year. Now, if we look at a closer look at the size of the healthcare service industry in China, again, this chart demonstrates almost an explosion in the market. By the year 2020, is expected to be at 8 trillion yuan, the whole market. And then if you fast forward 10 years more, this is going to double to 16 trillion. Now, if we compare Chinese markets with other developed parts of the world, it stays fairly immature. If we look at general medical practitioners per 1,000 people, China lags behind US, South Korea, UK, and Australia. And in terms of numbers, it's so on average, general practitioner in China serves like 70 to 100 people per day. And this shows that actually there is a very large opportunity for growth. And if we compare medical expenditure, so 61% of the total market is provided by government in terms of insurance, and 35 is so people actually pay from their own income. Whereas if we compare it to US, Germany, and UK, so US is a bit different. Only half of that is provided by the government, whereas 40% is provided by private medical insurance. Whereas in Europe, almost all of it is provided by governments, especially in Germany. And on this table, what we would like to highlight again is the opportunity for the healthcare growth in China compared to US and Japan. So the total market in terms of USD currently stands at 574 billion, whereas in US it's 3 trillion and Japan 470 billion. But from the perspective of a percentage of GDP, China lags quite substantially. It currently stands at 5.5% of the total GDP, whereas in the US it's 17% and in Japan it's 10%. And also in terms of healthcare expenditures on a per capita basis, in China it is at $420, whereas in the US it's almost 10,000 and in Japan it's almost 4,000. So there's a very high opportunity for growth in the market as well. And within that also, what we need not to forget about is the growing share of digital health. So in 2017, the whole market stood at 26 billion in terms of USD. And if you look at the year 2020, it is expected to increase by 4 times. And this is across all of the subcomponents, beginning with disease management all the way up to e-commerce. And this is partly driven by government initiatives as well, but also population in China is fairly tech savvy already. So that's comes as a natural outcome of that. And last but not least is education. This is, I think, one of the segments that is probably overlooked in the developed world. However, it's quite an interesting area where the market for private tutoring is the largest in China across Asia. And it also comes as a result of the growing share of the population with average household income per year of above $35,000. This is what you can see on the right-hand side. So from year 2008, 2018 expanded quite substantially, and now more than 1/5 of families in China earn north of 35K per year. And what this has translated into is quite a substantial growth in the China's education market. So on this chart, you can see that it is expected to continue grow at a 24% per year until 2022. And what this provides is an opportunity to, so here we compare traditional learning versus adaptive learning, and then internet or online-based education. What it provides is the capabilities to make education more tailored to the students, more specific. It's more adaptive. It's more flexible. It's non-linear, and this is what is actually appreciated by parents, and that's why it has been growing so fast and is expected to continue to grow as well. And on this chart, what you can see is the breakdown of the Chinese education market provided by Deloitte. And the, as previously said, it's, so their estimates stand to, for the whole market to reach 5 trillion RMB by the year 2025. And within that, the largest components are K-12 courses and personal training.
Just as a quick break, we'll sort of take one step back. We set out a marketing announcement yesterday about our private investment club. We have at the moment, this is kind of one of those nice coincidences, 2 private investment opportunities which are both focused on Chinese education and hitting 2 of the key drivers. One of those is on the Chinese tutoring, and one of the pieces of research that Max came across was the fact that Chinese parents are very, very focused on trying to obtain for their children the best education that they can. And this particular company does tutoring to try and help some of the Chinese students get into some of the best universities in the world, sort of Wharton, Princeton, Harvard, Cambridge, Oxford, etc. So that's been growing phenomenally in China. And the other one's a UK-based company, because what we've seen is with huge investments into the Chinese education, one of the hardest components, especially if you're looking from a sort of governmental level and a provincial level, it's teacher standard tracking. It's how do you make sure that your teachers are teaching the syllabus? How do you make sure they're doing a good job? How do you make sure this is being understood by the pupils? Testing is one side of that. But when you're looking at a country as broad as China, what we've seen is a lot of interest on trying to have more electronically connected ways of monitoring and feeding back on sort of student-teacher engagement, and also monitoring the standards of the teaching that is happening. This is a UK company that's being used by quite a few councils in England and also in Wales, that's seen a huge interest in both China and in Vietnam to be rolled out at both the provincial and potentially a country level. So this is where we're seeing from the model portfolios some of the thematic ideas that we're exploring, but also how this is crossing across into some of the private investment opportunities that we are also investing in for some of our clients as well. Sorry, Max, back to you.
Just wanted to reiterate that emerging markets consumer theme as a whole is a very vast market and opportunity. And what we try to do today is to provide you with an overview and 4 largest subcomponents of that theme that we believe in. And I think in the future, we will focus on every subcomponent in particular, and also provide you with the investment ideas. But as I said, it's a very big thing, and we tried to not to overload you with information today. I hope we managed to do it, but yeah, thank you for your attention.